Welcome to The Explainer. Today we're unpacking the ultimate case study on why trust is literally the foundational currency of finance. We're looking at the 170-year history of Wells Fargo. We're going to trace how an iconic American institution built this massive empire from the lawless frontier of the gold rush, only to turn around and nearly destroy itself from the inside out. If you really want to understand the true cost of fraud in the modern era, there is absolutely no better story than this one. Let's get right into it. And the stark contrast between these two eras perfectly illustrates the sheer, mind-boggling irony of what we're about to cover. Think about it. Back in the 1850s, this was a company famous for literally violently hunting down stagecoach robbers to protect their clients' hard-earned money. But fast forward to the 2010s, we see a systemic internal machine designed to rob its own customers, all just to meet corporate quotas. The ultimate protector became the predator. So how does a massive shift like that even happen?
Well, let's dive straight into our first section, the currency of trust.
To really understand how far they fell, we have to rewind all the way back to the lawless California gold rush of 1852. Founders Henry Wells and William G. Fargo, they didn't build this bank just by quietly holding on to people's money. No, they built a legendary empire by proving they were completely unbreakable when everyone else was collapsing. They transported miners' gold dust through the treacherous, untamed West, and during the massive financial panic of 1855, when other banks were shuttering their doors left and right, Wells Fargo honored every single deposit. Same story in 1906. After a massive earthquake literally leveled San Francisco, they reopened immediately. Their foundational product wasn't really banking at all. It was absolute ironclad reliability in a crisis. And their reputation was built on a pretty brutal truth. They were the ones who hunted you down if you crossed them. And that wasn't just some catchy marketing slogan, it was pure survival. They famously hired local posses to track down outlaws through the Sierra Hills just to recover stolen gold, and they publicized every single capture. This aggressive enforcement against external thieves sent a crystal-clear message to the miners: your money is safe with us. That strict enforcement built a bedrock of absolute trust that ended up defining their reputation for the next century.
So let's see how this shifts into the modern era with Section 2, the cracks within.
By the late 70s and 80s, banking deregulation had fundamentally changed the landscape, and the primary threat quietly shifted from the outside to the inside. Which brings us to our first massive red flag: $21.3 million. In 1981, Lloyd Benjamin Ben Lewis, who was an operations manager at a Beverly Hills branch, orchestrated what was then the largest bank embezzlement in U.S. history. He created phony receipts and manipulated accounts to funnel over $21 million to fake companies. This was a glaring, flashing warning sign of internal fraud. Yet Wells Fargo actually managed to distract the public from this. They scored massive PR points just 2 years later during the famous 1983 White Eagle heist. In that case, they played the victim of a $7.2 million robbery and enthusiastically helped the FBI hunt the perpetrators down. So this external hero narrative effectively masked the rot that was starting to take hold inside.
What happened next was an absolute, all-consuming obsession with scale. Under CEOs like Carl Reichardt and Paul Hazen, Wells Fargo went on this aggressive, dizzying acquisition spree just to survive in a rapidly consolidating banking industry. We're talking Crocker National in '86, a hostile takeover of First Interstate in '96, a massive merger with Norwest in '98, and eventually swallowing Wachovia whole in 2008. They were growing exponentially, prioritizing sheer size and market dominance, way over maintaining that foundational culture of trust we just talked about.
But it was that 1998 merger with Norwest that really injected a specific kind of virus into the Wells Fargo system. It's a little concept called cross-selling. Norwest CEO Richard Gavasevich brought this strategy over. The idea itself is pretty simple. Get a single customer who maybe just has a checking account to also get a mortgage, a credit card, and an insurance policy from you, right? On paper, that sounds like brilliant, incredibly efficient business. But in practice, it laid the absolute groundwork for a deeply toxic culture. Now, what's really fascinating and terrifying is how that strategy mutated. Section 3, the fake accounts catastrophe. This infamous internal slogan tells you literally everything you need to know about their culture entering the 2000s under CEO John Stumpf. 8 is great. The mandate was no longer to serve the customer. The mandate was forcing 8 different financial products onto every single household, period. This created a relentless, terrifying pressure cooker environment. Everyday branch employees were suddenly trapped between losing their livelihoods or doing whatever it took to hit these completely unrealistic daily targets. Let's break down the actual mechanics of this internal fraud pipeline step by step. First, management sets impossible daily quotas. Second, when people tried to do the right thing, like branch manager Claudia Ponce de Leon, who actually called the corporate ethics hotline to report the cheating, they were fired. Whistleblowers were eliminated. So step 3 becomes inevitable. Desperate employees, who are just trying to keep their jobs and feed their families, start forging customer signatures. They issue debit cards with dummy pins like 0000. I mean, they literally transferred real money out of customers' accounts to fund fake, unauthorized ones, all just to keep those daily quota trackers happy.
So what exactly happens when a 170-year-old foundation of trust completely rots away? Section 4, the true cost paid.
In 2016, journalists and regulators finally blew the lid off this massive deception, and the fallout was absolutely devastating. The true scale of the betrayal? 1.5 million. Regulators found that between 2011 and 2015, Wells Fargo employees had created 1.5 million unauthorized deposit accounts. Add to that over 500,000 fake credit cards. Millions of everyday customers were directly violated by the very institution that was supposed to be guarding their wealth.
But honestly, the most tragic number here might be the direct human cost at the branch level, 5,300. That is the number of lower-level employees who were fired for participating in this systemic fraud. Think about that for a second. An entire workforce corrupted and then just discarded by the executive leadership, the exact same leadership that had engineered this high-pressure nightmare in the first place.
The initial shockwave brought a $185 million fine from regulators, but it also brought the highly public and frankly deeply ironic downfall of CEO John Stumpf. The very man who championed this hyper-aggressive cross-selling model was forced to resign in disgrace, and the board clawed back $41 million of his stock awards. The architect of their modern success was essentially ousted by his own creation.
But you have to understand, the true cost wasn't just some one-time corporate fine. The true cost was 7 years. Because in 2018, the Federal Reserve, under Chair Janet Yellen at the time, did something almost unprecedented. They handed down a punishment that fundamentally locked the bank in a cage for 7 agonizing years.
That punishment was a massive asset cap of $1.95 trillion. The Fed essentially declared that Wells Fargo could not grow its balance sheet past that number. And look, in the world of modern finance, if you cannot grow, you are dying. This brutal ceiling effectively paralyzed their ability to compete with their rivals, cementing the true long-term cost of their internal fraud.
It took a massive, grueling, methodical cleanup to fix this mess, led by outsider CEO Charlie Scharf starting in 2019. He had to cut 55,000 jobs, pour vast resources into heavy risk management and compliance, and forcibly exit unprofitable operations just to stabilize the ship. It wasn't until June of 2025, after years of having to prove they had fundamentally changed their ways, that the Federal Reserve finally lifted that massive asset cap.
Which leaves us with a final, lingering question. In modern finance, once trust is broken, can it ever truly be rebuilt? The Wells Fargo story proves that while a bank's balance sheet might eventually survive a massive scandal and asset caps can eventually be lifted, the ultimate cost of internal fraud is exacted on the very soul of the institution itself. Thank you for joining me for this explainer. I really hope it gave you a fascinating new perspective on the invisible currency that truly runs the financial world.